Hi, my name is Davin Sunvik, and I'm going to teach you how to save $76,000 on housing just by timing the market. In case you don't know, my name is Davin Sunvik with Sunvik Realty. I'm a professional real estate broker, and we're going to be going over in this video whether or not you should wait to put 20% down or if you should put 5% down today. Now, with that being said, this is an estimate, okay? We're using a very advanced calculator that keeps track of all of the different variables in a potential real estate purchase, and some of those variables are unknown, and we have to put estimates in based on long-term trajectories, okay? So what that means is in theory, we could have given you too conservative of a number, and your savings could be even more, or we could have given you too high of a number, all right, and your savings might not be quite as extreme as what we said. So just remember that a projection is an estimate. It is by no means a guarantee. With that being said, let's jump right into the numbers. So we're using a $350,000 home as the example, a 7% interest rate, a 7% rent to home value, meaning that if the home is worth $100,000, it's going to be getting $7,000 in rent. If it's worth $300,000, be getting $21,000 in rent every single year. All right. Lastly, we're using a 3% inflation rate. Why 3%? The 110-year rolling average is at 3.25% at the time of this video. All right. The 30-year rolling average is only 2.5%. We chose 3% because it's a nice clean number in the middle between both of those. And get this, the housing market does represent 30% of the inflation index, and it is a very strong representative, meaning that housing prices typically outperform inflation over short-term and long-term periods of time because other assets don't compete as well as real estate does. So with that being said, inflation is actually a very conservative estimate for the prices of housing in the future. Now, in short-term periods of time, inflation doesn't work, okay? You can have a house worth today at $300,000 and tomorrow it's $390,000, but over long-term periods of time, it will inflate in value. Okay, with that being said, let's jump right into the numbers. So, your monthly payment, if you put 5% down, will be $2,212 per month. This is critical, right? I want you to know what your monthly payment is now, because what you'll find is in 10 years, that monthly payment is not going to be the same, even if interest rates stay the same. So if we assume a 3% growth in prices over 10 years, all right, that house will be worth $470,000, okay? During this time, we have actually spent $57,000 in total in negative cash flow compared to renting. Now, what I mean by negative cash flow, I mean your rent, right? Your mortgage plus your insurance plus your taxes, right? Plus your maintenance and your down payment, all subtracted from the cost of rent during that 10-year time period. And yes, rent went up in value, so the cash flow actually got more favorable with time. Your first year, you're spending $7,000 out of pocket, all right, in order to own that home compared to renting, versus in the last year of those 10 years, you were actually saving $1,400 every single year, okay? And I want you to know this number because it's very important, right? So the average number that we spent out of pocket was about $5,000 every single year. Compared to putting 20% down on a $470,000 home, all right, you would need to save roughly $7,800 every single year for a 10-year period to save up for that extra down payment, that extra 15% on top of your regular $24,000, right? To get to a $103,000 cash to close payment in order to own this home with 20% down. That is a lot of money in order to avoid PMI. And get this, is your mortgage payment actually going to be less? No, it's not. The mortgage payment on this loan is estimated to be $2,501. So means if you're buying a $470,000 home with a 7% interest rate, that is roughly your monthly payment, okay? That is insane, okay? Even with 20% down, you're still paying more per month, okay? So your total cash that you needed to not used towards other things, right, was actually more by putting a bigger down payment down because you had to save it, okay? Now, I do understand that not every person would take 10 years in order to save a 20% down payment. There are those extreme people who make a really high income and they save a significant percentage of their income, and they might be able to do it in 2 years or 3 years, okay? And those numbers would obviously change the results here. So let's just assume that you could get it in 1 year, right? You could get that 20% down payment in one single year. You would actually end up saving $1,000 over a 10-year period of time. Okay, and I can actually think of what I would do. So your down payment would be $77,000 instead of $24,000. And I can think a lot of what I could invest in. With that extra $50,000, I could easily earn more than $1,000 in a 10-year period of time. So with that being said, right, be very cautious of where you get advice from on the internet. Make sure that there is mathematics and real results behind every single piece of advice that somebody gives. And if you want me to go in more detail on my computer and show you guys the math and show you guys how my calculator works, I'm more than happy to. Simply comment down below that you want to see that video and I'll make it, okay? But I'm only going to make videos that you guys are interested in. So with that being said, give us a like and a subscribe if you want to save money on housing or real estate investing and you actually want to make money in real estate. With that being said, I appreciate you for watching this video.